We're going to break down a mystery that, on the surface, seems to completely defy basic math. In the world of oil, how does a pretty small leak in the supply chain end up causing a massive tidal wave in prices? Well, the answer involves pipelines, psychology, and a hidden force you've probably never even heard of.
So here's the core of it. Picture this. The world's most critical oil choke point, the Strait of Hormuz, gets shut down. The global oil supply takes an 8% hit. But the price you're paying at the pump doesn't just go up a little bit, it skyrockets by 60%. The math just doesn't seem to add up, right? Let's figure out why.
And this chart just lays the disconnect out perfectly. On the left, you see a drop in supply. It's noticeable, for sure, but it's not catastrophic. But on the right, you see a price explosion. The market's reaction wasn't just bigger, it was 7.5 times bigger. So what on earth is going on here?
Okay, to start, we need to look at the physical flow of oil itself. The very first clue to this whole mystery isn't in what was blocked, but in what actually managed to get through, all thanks to some really strategic and long-planned workarounds.
We've all heard the headline a million times. 20% of the world's oil flows through the Strait of Hormuz. So you'd think, if it shuts down, we're looking at a 20% global supply shock. But the real drop was less than half of that. And that gap, that difference between what we expected and what actually happened, that is our first major clue.
Now don't get me wrong, the closure was absolutely devastating for some. Bahrain, Qatar, and Kuwait, they were completely cut off. 100% of their oil exports relied on that strait. For their economies, it was an existential crisis. But for the global market, their combined output, while it's a lot, only adds up to about 16% of the Gulf's total production. They're just smaller pieces of a much, much larger puzzle.
This right here is where decades of geopolitical foresight really paid off. The big players, we're talking the UAE, Iran, Iraq, and Saudi Arabia, had all built these massive pipeline networks to bypass the strait entirely, giving them access to other coastlines. And these weren't just small projects. The Saudi pipeline alone could move millions of barrels a day. This infrastructure, this planning, is the single reason a 20% threat only became an 8% reality.
So, okay, we figured out why the supply drop wasn't as bad as it could have been. But that still doesn't explain the price. Not even close. To understand that massive overreaction, we have to leave the world of geology and engineering behind and dive into the world of economics.
The absolute key to this price explosion is a concept called elasticity of demand. It really boils down to a simple question. If the price of something goes up, are you going to stop buying it? And for oil, in the short term, the answer is almost always a hard no.
Think about it like this. If your favorite cereal raises its price by 10%, you might just shrug and grab a different brand, or maybe switch to toast that week. No big deal. There are tons of substitutes. That's called elastic demand. But with oil, there are no immediate substitutes. Your car needs gas to run. A trucking company needs diesel to deliver goods. So even when the price goes way, way up, people and businesses just have to grit their teeth and pay for it. That's inelastic demand.
And why is it so inelastic? Well, think about it. 3/4 of the driving we do is pretty essential. Getting to work, buying food, taking the kids to school. And get this, that's just our personal cars, which are only about 1/4 of all the oil used in the world. The rest is powering the entire global supply chain. Sure, over a few years we can adapt. We can buy electric cars, maybe move closer to work, but tomorrow, you still have to get to the office. The world's demand is locked in, at least for now.
So economists have studied this for decades, and they have a number for it. The consensus is that the short-term elasticity of demand for oil is about -0.1. What that means is, for every 1% you need to cut demand, you have to raise the price by a staggering 10%. So, with an 8% supply shortfall, the market needed to destroy 8% of demand. And if you do the math, that requires a huge price hike. Suddenly, the math starts to make a scary amount of sense.
But here's the thing. Economics and pipelines, that's only 2/3 of the story. There's a third, absolutely crucial element, the human factor. You see, the market isn't a perfect calculator. It's a collection of people making bets on the future.
You have to remember, oil prices aren't set by some perfect machine. They're set by traders, people, betting on what's going to happen next. And their collective belief can actually become a self-fulfilling prophecy. In this crisis, traders initially bought into a really comforting story, not the alarming reality that was unfolding.
And this is where the story gets really weird. When the crisis first kicked off, the market didn't panic. The initial strikes happened, traders had a whole weekend to process the news. But on Monday, the price only went up a measly 6%. By Wednesday, it was basically flat.
This was happening even as ships were being attacked in the Gulf. The market was bizarrely calm.
So why so calm? It all came down to the narrative. The official statement from the White House made it sound like a limited, surgical operation. Traders, they looked at what happened in the past, and they believed what the administration was saying. They bet on a short, contained conflict. The market was pricing in a story, not the actual facts unfolding on the water.
But a story can only hold up for so long. And that comfortable narrative traders were telling themselves, well, it was about to collide with a force way more powerful than a press release, the global insurance market.
This is the moment that woke everybody up. The world's biggest marine insurers, through this body called the Joint War Committee, did something really dramatic. They declared the entire region a high-risk zone, and, with just 72 hours' notice, they canceled all existing war risk insurance policies. And without insurance, these multi-million-dollar tankers with $100 million cargoes, they're just not going to sail. It became a de facto blockade created not by minds, but by actuaries.
And when insurers did start offering new policies again, the cost had shot up more than tenfold. This massive new cost was a crystal-clear signal to the market. The risk was real, the disruption was not going to be short-term, and that old narrative was dead wrong. The price of oil, of course, reacted immediately.
Okay, so we have all the pieces of the puzzle. A supply shock that was smaller than expected, the unforgiving math of inelastic demand, and a market of traders who woke up late to the real risks. But what does this all mean for the future?
For years and years, the market operated on this really dangerous assumption that the wealthy Gulf states were somehow immune to all the turmoil in the region. This whole event just completely shattered that illusion. It revealed a deep fragility that traders could no longer ignore. And here's why this matters to you and me. That shattered illusion creates uncertainty, and markets have to price that uncertainty in. A new risk premium is now basically baked into every single barrel of oil coming from the Gulf. This isn't just a temporary spike, it's a long-term shift that will very likely mean higher, more volatile prices for all of us.
So that leaves us with one final, pretty unsettling question. The pipelines and the economics, they're powerful forces, for sure, but the most lasting impact of all this is psychological. Now that the market has been reminded just how fragile this choke point is, will it ever see Gulf oil as truly secure again? And if the answer is no, is the era of cheap oil over for good?